Hello, everyone. Welcome back to our Wednesday workshop at 1. My name is Brian Martinez with NuView Trust Company. Today, the topic is crowdfunding. We're going to go through the basics with our guest speaker, Kaylee McMahon. If you don't know her, she's a good person to know, great person to have in your network. Before we get started, just a few things I want to cover. What is a self-directed IRA? A self-directed IRA is like any other IRA. The only difference, it gives you the ability to invest into alternative assets. True brick and mortar assets like real estate. You can do private notes. You can buy mortgage notes that are existing, whether they're performing, non-performing. And notes are usually secured by things like real estate. Then you have things like tax liens. You can invest in land. You can invest in cryptocurrency. I mean, the list goes on and on. Now, the benefits of self-direction, it gives you diversification in your retirement portfolio. You want to put all your eggs in one basket, number one. You also get a tax savings. It's either going to grow for you tax-free or tax-deferred. It just depends what type of IRA that you are using. And you're investing in what you know best. You're probably already making these types of investments with your own cash. Why not do it in a retirement account as well? So there's a couple of different types of plans that you can use to self-direct. You have your personal plans, a traditional IRA. Contribution limits are $6,000 a year, and there's a catch-up contribution of $1,000 if you're over the age of 50. And then you have your Roth IRA, also $6,000 a year. You can contribute with a $1,000 catch-up contribution if you're over the age of 50. They're just taxed differently. Traditional IRAs are tax deferred. You're going to pay the taxes on your contributions, and it's going to grow tax deferred. What that means is once you start taking distributions after the age 59 and a half years old, you pay the taxes based on whatever your tax bracket is in that calendar year that you've taken that distribution out. The Roth IRA works the other way. You're not paying the taxes on the growth of your investments. You're paying the taxes when you make your contribution. And then when you take the money out, it grows tax exempt and you take it out tax free. So would you rather pay the taxes on the seed or the crop? It's up to you. You have to figure out what strategy works best for yourself. Always discuss it with a financial advisor. Then you have your employer plans. So if you're self-employed, you might want to listen to these plans. You have your solo 401k plan. It's one of my favorite plans. There's a lot of perks into having this plan. In order to be eligible for the solo 401k, you must be self-employed with no employees. You can contribute up to $61,000 a year to this plan. And there's an additional $6,500 catch-up contribution if you're over the age of 50. And then you also have a SEP IRA, same thing. You can match up to 25% of your self-employed earned income. The maximum is $61,000. There is no catch-up contribution with the SEP IRA. And then you have a simple IRA. The simple IRA, the maximum is $14,000 with an additional $3,000 catch-up contribution if you're over the age of 50. Great for small businesses. There is a mandatory 3% match if you do have employees. So of the 3 employer plans, the simple IRA is the only one ideal if you have employees. The SEP IRA does have a match as well. The way the SEP IRA works, if you have employees, whatever percentage of your income that you matched to make your contribution, you also have to do the same for your employees. So if you contributed 25% of your income to maximize on that SEP IRA, then whatever your employees earned, you have to match 25% as well for all eligible employees. And then you have your specialty plans. You have your education savings account. So any kids or grandkids you want to save up for college, this is a great way to do it. You can contribute up to $2,000 a year. It is not tax deductible, but it will be taken out tax-free for any type of school expenses, whether it's college, room and board, internet, books, all of those things you can take it out tax-free. But you want to partner it with some of your other plans because that's not a whole lot you can contribute to that plan. But the power of powering these multiple plans together is really how you're going to build that wealth and grow this plan for your kids' college. Then you have your health savings account. Health savings accounts are just like they sound. You have to have a high deductible healthcare plan in order to be eligible for the health savings account. If the plan just covers yourself, you can contribute $3,650 a year. If it's a family plan, $7,300 a year you can contribute. And there's an additional $1,000 catch-up contribution if you're over the age of 55. So the health savings account is pretty cool because it is tax deductible going in. So as you make your contributions, and when you take it out for any medical expenses, it's tax-free. Now you can accumulate those medical expenses, pay them out of your pocket and save those receipts as long as you like. Keep that money you've contributed to the plan working for you and invested and growing. And then, when you're ready, 10, 15 years down the road, you can cash in all those receipts and take that money out tax-free. So there is not really a deadline that says you have to take that money out as soon as you have a medical expense. So some of the other options that you can invest in are private entities, whether it's an LLC, a joint venture, trust, syndication. That's probably the most common type of investment we see clients making when they're passive investors. If you're more of an active investor, then real estate. You might want to invest in things like tax liens, apartments, foreclosures, condos, offshore real estate, land, any commercial property. Now, a lot of times the apartments, self-storage, mobile home parks, any commercial property usually falls more under the private entities because you're investing as a group of multiple people investing into the company or the LLC. Cryptocurrency and notes are also included. I like notes because they are secured by real estate. If it's a secured note, then that means that there is a borrower paying you back interest. You get to negotiate the terms of the note, typically if you're the one that's creating the note. And if they don't pay you back, just like a bank can foreclose on the property, you can do the same thing, and you can do it in your IRA. Unsecured notes usually have a higher interest rate, but it is not secured by anything like real estate. So there's no collateral. So you're taking a little bit bigger of a chance, but you can charge more interest. All right. With that being said, I'm real excited to bring Kaylee McMahon. We go way back. We met at Think Realty, a conference in Dallas about 4 years ago. And we brought her to NuView, at least once a year to give a good presentation on her background. She's known as the apartment queen, and she definitely lives up to that name. Kaylee, I'm gonna go ahead and let you take over from here. I'm excited to have you.
Hey, everybody. How are you feeling on this awesome magical hump day? I'm so grateful to be able to take up some space in your life right now, for you making the time to educate yourself, because educated investors always make the best investors. And so putting this time into yourself, you will always see over 100% return on the time that you're spending here today to be able to learn something for yourself, your children, your family, your future, and be able to act upon it is really how you're going to get some, bang for your buck, I guess. Your time buck. So what I'd like to share with y'all today is a little thing that we created that's taken us 7.5 months to put together. So it really wasn't as easy as our typical syndication structure, but it's called crowdfunding. And it's something that's not really used readily in the real estate industry. And so because it's different, I found that a lot of investors won't touch it because they don't understand it, right? So if you're able to understand how it's structured, how the risks work, voting, what kinds there are, we'll go over all those things today, then it makes it more palatable when there is an opportunity available that you say, okay, I understand how crowdfunding works, and I'm either interested or not. So let's go through a little bit of that. And then to wrap up, I heard a couple of things that I do want to let you guys know about, whether it's other experiences our investors are talking about right now, that I want to share a quote that we got this week from one of our investors. And I want you to pay attention because I doubt it, but I could be wrong. I don't personally go look at my IRA every day and go, what's going on with my value of my IRA and how's it performing in the market, because it's not under your control, basically. So I used to put it in a back pocket, right? But I'm going to bring some things to your attention that I think are really important to be able to advocate for your financial literacy, be able to advocate for your financial future. And so we'll start with a little bit of instruction, a little bit of market information, and then, what are the possibilities? So let me screen share real quick. So we're going to talk about crowdfunding basics today. A lot of individuals know crowdfunding. We'll talk about it in a second from other places. For example, Indiegogo, Kickstarter, those are really common when it comes to a startup company. So we're just going to reframe your mind a little bit with other uses that it can be applicable to. So a little bit about us, just a tiny bit. Apartment Queen Investments is the name of our firm. We're an experienced operator team, over actually 72 million assets under management currently. We operate and purchase in only landlord, business, and tax-friendly states. We are primarily focused in Texas. We have big goals to hit 200 million assets under management by 2022, so this year. And we are looking to create $1 billion invested by, for, and with women by 2030. So that is our big, hairy goal. So what the heck is crowdfunding? Crowdfunding is a relatively new and evolving method using the internet to raise capital to support a wide range of ideas and ventures. Typically, these are mission-driven ideas. An entity or an individual raising funds through crowdfunding typically seeks small individual contributions from a large number of people. Individuals interested in the campaign or members of the crowd, as you can see here, may share information about, or we may share information to the crowd about the project, the cause, idea, or business with each other, and use the information to decide whether to fund the campaign based on collective wisdom of the crowd. So there's 4 types of crowdfunding. There's donation crowdfunding, reward crowdfunding, debt and equity crowdfunding. For example, this is kind of what I hit on earlier, debt-based. What does that mean? So debt, contributors will only receive interest payments in exchange for their contributions. So some examples of the platforms that are out there for this for you now are Funded Here, Crowdo, Moolah Sense, GoFundMe. Something that would be a equity type of crowdfunding where contributors, you guys, receive shares in exchange for your contributions would be something like Seedrs, AngelList, CapBridge, Funnel. There's actually a whole bunch of other ones out there that you're probably familiar with. But anyway, like Fundrise, CrowdStreet, I mean, there's actually a lot, but point is that there's different types. So there's 2 more types. And there's reward-based and donations-based. So reward-based contributors, you guys, are promised rewards in exchange for your support through the first priority access to the product once it goes live. So Kickstarter, like I mentioned earlier, Indiegogo, Ulele is another one where basically you're able to get in as a founding member of a company. It's essentially a pre-seed round to be able to make the company get to its next funding phase that it will need based on growth. So without going too much into that, typically that applies to tech, that applies to small solutions, products, small local businesses and things like that. But will typically invest a very, very small amount because they typically know nothing about the business or know a little bit and want the opportunity to be able to support, bringing money from Wall Street into Main Street. And the 4th type is donations based. So donations are charitable and tax deductible. So obviously that's a benefit to you if that's what you care about. So Friend Fund is a nonprofit, for example, that does this. I'm sure all of y'all are familiar with Patreon. That's another place that you can host a Patreon campaign. And You Caring is another example of a donation based crowdfund. So regulation crowdfunding is a particular exemption. So regulation crowdfunding enables eligible companies, and they have to be eligible, it was quite the process, to offer and sell securities through crowdfunding. So it's just another version of what you've probably seen out there in syndication. Syndication is just like another name for like pooling funds together. So it's just which form are you filing with the Securities and Exchange Commission to sell a security. So regulation crowdfunding is operating under crowdfunding law, crowdfunding portals, and as of the current moment, the requirement by the SEC is, and actually FINRA really, is that we have to operate under regulated crowdfunding portals. So typically those individuals that open the crowdfunding portal are registered broker dealers, which you can find at like brokerdealer.org, something like that. But then they go through quite the process to be able to open up the platform. They do help us sometimes, but it has to go through a portal. So for example, we already own one called InvestNext, and currently all of our accredited investors can go through that method to invest. But those that are crowdfunding are not accredited individuals for this sense of what we're doing. And so we have to have a whole nother separate portal that's just dedicated to crowdfunding. So I won't make any comments there, but it's just required by law right now. You'll be raising through a hosted demo day. So basically there is what we normally do with a with a syndication is we normally have like a webinar that we go over the pitch deck and we talk about, how did we find the deal? What are the benefits? What are the risks? All the things, returns, business plan, exit, what your returns look like, all of that. And essentially that would be the day that would be equivalent to a demo day here. So when I say demo day, it's essentially an opportunity, whether it's a business like this where we go in front of individual investors, or if it's like, for example, something that you're used to with Kickstarter, they would also have a demo day in front of venture capital companies and also in front of angel investors. So they call it demo day. We just call it a webinar. So anyway, or a pitch deck. So essentially it's just different terminology, same thing. So both accredited and not accredited investors can actually come through regulation crowdfunding. And so it just depends on what you want to invest in, who you want to invest in, also how long you've been considered accredited, and what kind of funds you want to invest. So for example, the majority and all the whole industry average for minimum investment typically for syndications for multifamily is about $50,000. So, if you're me, when I got started, I didn't have $50,000. And so I had to find another thing to passively invest into. For me, it was notes. But point is it's It's also available for accredited investors who maybe don't have that minimum amount or don't want to spend that minimum amount. That's okay too. Oh, and I didn't touch on that. There are for sure investment limitations on non-accredited investors. So in our portal, for example, when you go in there in the crowdfunding portal, there is a documentation section that walks you through a chart. I'm not sure if I have it in here or not. I hope so. But what it does is it essentially gives you a matrix for, depending on your net worth, your liquidity, how much you have in, say, retirement accounts, and then some other factors. It limits you at how much you can actually invest. And so I found a lot of investors that typically can put in like 50K plus. They were limited at like 42 or less than that, just depending on a couple factors. So the idea there is to make sure that the investor is only investing below pretty much 10% of their income or less, so that the risk for that investor goes way, way, way down. And they should be way more comfortable investing in something that gives them a limit. Make sure that they stay in a safe range. So crowdfunding law, what does that mean? Okay, so there's business law, like Texas has the TBOC, the Texas Business Code, basically. That's one example. Every state has their own. There's securities law, so there's business law, and then layered on top of that, there's securities laws. We already know all these things we have to do to get approved by SEC and FINRA to be able to host these types of offerings to sell securities. But on top of that, there's crowdfunding law. So there's like 3 layers of different rules that we have to follow. And all of them essentially are meant to keep the individual who's investing as safe as possible and keep the information as transparent as possible to the investors. So here's some of the rules that we really have to focus on. So it requires that all transactions under regulation CF crowdfunding has to take place online, like I mentioned, through an SEC registered intermediary. So these portals, either a broker dealer or a funding portal. It only permits a company to raise a maximum aggregate amount of 5 million through crowdfunding offering in a 12-month period. Now, what's interesting with that is that used to be 1,070,000. So 1 million basically. And then all of a sudden in 2021 in March, that changed to 5x what it was. So now is why it starts making sense for real estate, but those are still the rules as of now. You must limit the amount of individual non-accredited investors that can invest across all crowdfunding offerings for a 12-month period, which is kind of taken care of by those rules on the back end when investors are investing, and then it caps it at a certain number of investors per raise. It requires disclosure of information in filings with the commission. So the Securities and Exchange Commission, also with FINRA, to tell you the truth, and to investors in the intermediary also facilitating the offering. So, you normally have your monthly reports, right, that you get from your sponsor when you invest into something. And so what we've done in this situation is we've actually brought on a fund a fund CPA or CFO of our company. So essentially what she does is provides an audit of all of our books. So it goes to match not just what's showing up on the balance sheet and profit and loss statement, but making sure double checking, cross-checking, does that match up with the statements and the bank records and the credit card records and everything that was actually done in real life. So that audit for us is done annually. And what that does is that helps us to be able to basically take care of all these laws, the crowdfunding, the securities, and the business laws by just being uber transparent. So not every company has to do that, but we find that just solved taking care of all of this basically. So crowdfunding portals, let's talk about that a little bit. So in contrast, a crowdfunding portal platform is like an online marketplace. What it is it's where fundraisers or funders, fundraisers and funders can connect with investors to fund their projects independently. Unlike broker dealers, crowdfunding portals have a number of limitations to the kind of activities and services they can perform. So, I have a long list of those who I had to talk to figure out what kind of offerings that they even want to host or what they were willing to. So each one's different basically. So this is actually a different kind of portal, but it's just an example. So for example, if you were going to invest in something, how it would work through crowdfunding is, so for example, if we wanted to raise $5 million and we wanted to take $5,000 minimum, that's 5,000 investors. We cannot do phone calls with all those investors. We cannot do emails with all those investors, et cetera, et cetera. So the way that we've solved that problem is essentially putting all of the information that the investor would need in a portal. So the investor would go from interest level to the portal and to look at everything. So all of the offerings, what's available, your documents once you invest, because this is like an example of you've already logged in. Oops, go back. But point is everything that you're going to need, whether it's pictures and information and documents and to be able to invest, and your dashboard of all of your investments and your tax documents, for example, if you have K1s, et cetera. everything is going to be in the back end of your crowdfunding portal, and even those audit reports annually. So that's how that works. So by the way, when I say the word accredited investor, some go, well, what does that mean? I'm not sure, because it just changed too in 2021 when the crowdfunding rule went from 1 million to 5 million as a max raise. So did the accredited investor definition change. So just to re-clarify for everybody, we all know the rule is typically, okay, one, you make $1 million net worth, or you have $1 million net worth minus your primary residence, or as a single person, you make $200,000 a year, or as a couple, you make $300,000 a year. That's been kind of like the general rule. But in addition to that, I'm not going to go too much into this. You can look at it on the SEC's website. Sorry, this is bugging me. The SEC's website. But essentially, we're able to also be considered accredited if you are a broker dealer, if you're considered a SEC regulated, state regulated broker dealer. Also, if you are a tax exempt charitable organization, corporation that has any assets in excess of 5 million, if you're a director, executive officer, et cetera, or general partner of a company that is accredited. So for example, if you are in a general partner company like we have, a bank, saving, loan association, insurance company, registered investment company, or basically business that have assets in excess of 5 million, an enterprise which has all accredited investors in the group, an individual with a net worth or a joint net worth. Oh, I already covered that one, and these ones, and then a trust with assets exceeding 5 million. So it cannot be formed either to then acquire the securities that the investment sponsor would have for you. It has to have already been in existence, and there's more rules, online as far as like how long. Like everyone knows about the COVID money that was out there. If you were applying for certain business loans, for example, your company had to be in existence and operating for a certain period of time. It's the same thing. So this is old and wrong, but I am going to cover the bottom of this. No, I'm not. I'm going to go, wait. Do I have the wrong presentation? 1 second. No, I don't. I guess that is the end of it, but this slide is incorrect. So I'll go back to slideshow. So for example, what I was going to say is that this is where it was going. Sorry. The capital requirements that are typical for an accredited investor when you're investing in as an LP in a deal like this, or a multifamily apartment, which is what we do. Typically, you're going to be investing $100,000 minimum, but the average, like I mentioned, is $50,000. So there's some that will do lower, some that will do 75, etc. And then if you are going to invest in a project like this as a main sponsor, so instead of being a limited partner, you could also come in as being one of the other partners. So that minimum investment would typically look like $1 million if you're considered accredited. So that will all change depending on what is available in the crowdfunding offering. It would all be defined, but typically it's going to be a lot less than this. So that's kind of why people do crowdfunding, to bring more into the crowd to be able to accomplish the same net raise, just with more people in an efficient manner that is palatable and manageable, if you will. So for example, if we're going to raise money for multifamily, some examples of what that money would be used for would be marketing, educational events for raising money for the fund or the apartment offering, earnest money deposits, feasibility costs, legal fees, and other soft costs. Every deal on the pitch deck will actually outline, or it should outline, what all those soft costs are broken down, because they do change, deal to deal. But essentially, the funding is used to acquire the asset, operate the asset, and be able to discharge or sell, and be able to get investors their money out of the deal. So one thing I was going to say earlier that I kind of heard and wanted to latch on to a little bit was, it's interesting how you can invest with your retirement account, right? So you're going, okay, great, Kaylee, I see you. I don't have this much money in my retirement account. I'll cover that in a minute. But another thing is, for example, I've known a few IRA investors that are housed at companies that are private money lenders, for example, and they have quite a bit of capital that they want to deploy. It's already self-directed, and there's some taxes that can be incurred, or usually are incurred, whenever you're investing as a limited partner or an LP. So if you're using your self-directed IRA, it depends on which kind you're using, there's typically a UBIT or UDFI tax, and that tax essentially comes into the point when you're making a gain. So there's ways to change your IRA entity to avoid that. Or what you can actually do is, as kind of like a private lender or a private money lender, sort of, you can bring a larger chunk in and be a partner in one of these deals, an active partner, and be preferred equity. And that's something that I have a surgeon friend of mine that does that all the time, because he's able to be on the operator side, which means he makes a little bit more money because he gets a preferred return, meaning paid first because he's subbed to the lender. The lender on the deals gets paid, then pref equity does, but he also doesn't incur that UBIT or UDFI tax. So basically he makes better returns, doesn't incur any tax, and keeps his money in his account tax free. So that's like a cool hybrid thing I just kind of learned about once he invested with us that was nifty. And I wanted to share that, but that's another option, as a way that you can invest in these deals, not just as a limited partner, but that's also something else. So in akin to talking in the language of crowdfunding, that's similar when I say here, angel or seed capital, essentially that partner or that person coming in with preferred equity would be more akin to that type of investor. It's just, when you're investing in crowdfunding, that's typical to have venture capital funds, seed, or angel funds being invested. So that basically covers all of what is crowdfunding, what does it operate under. So one thing I'll clarify too is that, for example, when you file a under Reg D, typically what we see in not crowdfunding, what we see typically in a syndication is that when I used to either take friends and family into my deals, it was a 506B as in buddy deal under Regulation D as in Delta. So the SEC is like, we either have Reg D or Reg C. And in this situation where I'm comparing. So Reg D, the two exemptions to be able to raise quick and be able to take investor money with securities offerings is to be able to offer friends and family, so the 506B buddy, or 506C, I call it like commercial. So you can actually advertise it publicly. 506B, you can't. You just have to tell your friends and family. You have to have a pre-existing relationship. Well, so that's under Form D that's filed at the SEC. So crowdfunding is Form C. So it's different. And I wish that I could show you a lot of the things that are in my head that are very, that's confidential information. I can't, but essentially what you do is follow the process where you are putting together these investment documents that have to follow all these three layers of business and legal code laws. Then once you get your offering together, then again, there's more rules when it comes to this one particular thing. So a Reg D offering, basically you're able to raise unlimited amounts of money from especially accredited investors. That's just one thing I'll say. 506C, you can unlimitedly advertise anywhere, what you'd like. When it comes to crowdfunding, what I had to do not only was come up with these documents, but I also had to go hire a CPA firm to audit our financials. So this is auditing all of our business financials. And in addition to adding all of our resume, what we've done in the past, we had to basically go through all of the deals that we have exited, all the deals we've purchased, how did they go, risk factors. I mean, just like an extra layer of a lot of stuff. So just if you're going to invest in a crowd fund, I just do want to let you know that there's an extra layer of checking or protection with that financial review or financial audit that has to happen. That has to actually be turned into FINRA and the SEC whenever we're submitting for our actual approval of our offering or of our deal. Sometimes it's an offering like a fund, and sometimes it's a deal individual. So either way, though, there's that extra layer of due diligence that FINRA does on any crowdfunding investor. So that's something else I wanted to let you know. And then when it comes to crowdfunding, like it mentions, you can have accredited or sophisticated investors either way. It doesn't matter, just depends on what's in the offering. And so I gave you a little bit of options, when it comes to what a IRA can do. Now, something I do want to bring up, and I'm going to read off something to you guys, ladies and gentlemen, that I received. So I do have a women's group it's called Women Who Invest Council. So we counsel each other on, hey, you invest in gold, you invest in stocks, you invest in cannabis, you invest in whatever. And so we get together quarterly and we go through our portfolio and talk about what's working and what's not. Well, one of our investors was kind enough to talk a little bit about something that she experienced and was pretty disappointed about 2 weeks ago. And I want to share this with you because, like I mentioned in the very beginning of the webinar, I'm not typically someone that is looking at my retirement account, if I'm employed somewhere, for example, because I'm working, I'm paying attention to my children, I'm doing other things. I'm not really maybe someone that's day trading stocks. So why would I be paying attention to every little detail? Well, so she mentioned this to me, so I'm just going to read it off as brief as I can. But Brandy is her name. She let our group know that, hey, I recently moved my Roth IRA to being self-directed. It is not a difficult process, but it takes time. And in my case, due to the lack of follow through with my originating account, so the person that was holding it before being self-directed, my Roth was not being put into a cash position until a week after I requested the sale. In that week, I lost $10,000. Why that may be small to some, it isn't a small loss to many of us. This country's financial market is changing at a breakneck speed. If you have been on the fence, I implore you to do something now to hedge your investment and do something with your money and be empowered with your own funds to hedge your investment in the stock market. This group, and she's talking about our group, is strategically minded enough to help you decide what to do with your money once it's out of the market, but you cannot protect your money from the volatility of the market while it's still in there. We are on the brink of recession. Some argue that we're already there, and the Fed has announced yet another rate hike. And this was before the last one, and we have another one coming. So what does that mean, basically? So that means that things are very unstable right now, and you really cannot predict what's going to be happening to those accounts that you have stuck in the market. So what you can do is control the funds that you already have. So for example, if I had, I don't know, $15,000 in the market and I lost $10,000 of my investment by having to wait because I didn't self-direct it fast enough, I would be very upset. So now's your time to protect your capital and be able to pull it out of the market and put it into real assets that are either going to appreciate over time, which is kind of the entire point that we use it to invest into real estate, especially cash flowing commercial real estate, because it's almost guaranteed. And worst case, over a certain time period, while we continue to have these rate hikes, which always affect the stock market and instability of everyone's decisions when it comes to doing business, opening more business, et cetera, you're at least protected by having it stuck in a physical asset until the market makes up its mind, sticks somewhere, and then you can pull it out and do something with it that may be more stable or more consistent in another non-physical asset industry, like tech, for example. But when it's volatile, it's a point in time where you could potentially lose all your funds overnight, or not all yours, but I just gave that example. I'm so happy that she shared that with us, just because we're all either thinking it or dealing with it, but no one was willing to talk about it. So Brandy, if you're watching, thank you for that. So I just wanted to share that a little bit about crowdfunding, about what's happening out there, in the market. I want to share a little bit at the beginning. I did share a little bit about our team. I did just make this deck last night, and I wanted to show y'all a couple of quick pointers about our team, about us and what we do, and why we're important for you to be paying attention to us right now. So I'll cover a couple quick things. So basically what we do when we invest into future deals is we look at these markets right here, and we actually are invested in all of them right now, except for currently Austin and San Antonio. But I just got back from Austin right before this, and that may change soon because things are falling out of contract right now based on the changing interest rates. So that's not how you go there. So here's something that makes us competitive and different. And that's really what should speak to investors is, who am I investing with? Someone that has a track record, somebody that actually produced before, somebody that's in the long game, and then also is affecting and changing the community. And instead of just putting more money into Wall Street, again, is affecting and changing Main Street. So something that we've noticed, or problems we've seen, is that 83% of the industry in commercial real estate is only white male. We are adding diversity in leadership, and we are women focused. So we have diverse fund managers. And what does that mean? So just transferring that to numbers, over time, women that are hedge fund or fund managers typically tend to perform 30% better on average. So not only is it something that I believe is just creating more equity, I would rather see that number where it's at least half women and half men, like it is biologically in life, but being able to also make more profits for the business, because we tend to be a little bit more risk averse. So we're great to lean on when it comes to times of uncertainty. And then also we've noticed an issue where investors typically have to be a qualified investor to be able to invest. That means accredited, like I covered earlier, or sophisticated, meaning that you have enough business or real estate knowledge to be able to know all of the risks and benefits of your investment, and basically sign a piece of paper saying, I see those risks, I agree with those risks, and I waive my right to kind of do anything about it. You know what I mean? So those are the only investors that have been able to access multifamily investment for quite a long time. And then again, the third thing that we notice is a challenge is that the minimum to invest is typically $50,000. If I was told that, well, I was, at 19 years old, 22 years old, that, oh, you need 50K, I'd say, well, I guess I'm going to stay at this corporate job and I'm going to work until I'm 50, 45, and then I'll have enough cash in my bank to be able to start investing. Well, then I just missed out on the compound interest curve my entire life. Right. So those are some problems that we see. And if we want to get more wealth into the hands of women, which tend to 80% of the time come back into the community because that's what we care about, which also affects and improves the planet, we can do it at a lower amount and do it sooner. So those are some issues that we see. And then here's another reason why we have a competitive edge. So we solve those issues, one, and two, every partner, every lender, every manager, property manager, asset manager, partner, potential equity source, everybody that we work with is highly vetted by trusted, results proven referral only. That has been my biggest lesson in life, is making sure that everybody that we are working with, if they're handling capital, that they have a proven track record of doing so and doing so well. So I want you to let you know that that's how we do things. And I also own a security company as well. So especially before we get into business with somebody, anyone that could possibly affect the whole investment, that person is highly, highly vetted for quite some time before we even partner together. So we also provide education and investment opportunities, because our big hairy goal is to create $1 billion invested by, for, and with women by 2030. So we're looking to really change the planet, and we can do this through real estate. So there's a little bit about me. Again, we have about 72 million assets under management. I came from A&M. I've raised a bunch of money in the last couple of years, and I'm looking to do some more. That's my dog. This is a little bit more about our team, and I'm happy to send this deck out later because I didn't plan on showing this. So really, I'm just scanning to show you guys a couple of things. If you want to look at our business model, that is also really boring, but in here, how we validate a market is also in this presentation. And there's 5 things we always look for or we don't invest. This is our marketing plan. These are all of the assets right now that we currently have invested in or sold, gone full cycle. That's the words we use. So I'll show you a little breakdown of that in a second, but we're looking right now at 6 off-market deals that we just found this last week that fell out of contract. And so we're looking to grow this portfolio even more, of course. But just to give you an idea, again, I can send this to you later because I'm not going to go through all these. We have a couple of case studies. If you want to go through the first asset we ever sold, the second, the third, and I actually haven't updated the 4th on here, but net is that you can look at our actual case studies of what we've done. And again, I covered our why. And it's really at the base of it. The why comes from my freedom from abuse and codependency, because I was making myself vulnerable by not making sure that I had something to take care of myself, to give me monthly cash flow, a safe place to live. I was vulnerable to other people being able to treat me however they decided to. And investment, if I look at my track record in creating passive income, was that turning point in my life that I was able to turn everything around and be able to start advocating for myself, which was very important. I know many women specifically struggle with mindset shifts, and education is really what it takes to create their own independence. That's why we offer webinars like this, to be able to make sure that hopefully if you don't have a lady with you watching this now, you can take the recording and share it with her. Because we have, for example, in our fund, one dad that's got 5 girls, 5 daughters, and so not only are they members of his company, but also they learn all these things at a very young age that, as an older accredited investor, he knows now, but he can now change the potential life path of 5 people who may have 5 kids themselves. So it's creating generational changes in wealth and also stopping possible cycles of abuse. Real estate is the fastest way to grow generational wealth. And like I said, I've experienced it firsthand. When we understand the risks versus rewards, and we have control of our financial destiny, we ultimately have control of our independence in life. And for me, that's been so important to me, to be able to restart, learn myself, and not be vulnerable anymore financially to everybody else's whims. So it's time to end the bondage and dependence on others and stimulate the economy. Massive benefits come from investing and being able to not only make money, but being able to stop codependency is a huge thing that I'm passionate about. So we have an investor portal. It's a little snapshot of it, a little bit about our typical capital requirements. So again, if you want this presentation, I'm happy to send it to you. Our future deals that are coming up would be what we could talk about, after this educational webinar. And then this even walks you through like what our investment process looks like, which is super typical. You, again, step here that's blurry. Number 1, go get educated. Like that's what we're doing today. And then once you feel confident in the investment class that you want to get invested in, or actually I would say self-direct your account first, then go get yourself educated as fast as possible. And when you pick an asset, then you start evaluating. So until you're educated, I wouldn't go look at random offerings. So I'll give you a quick book. So for example, if you're a very busy professional and you're like, what's going on with the market, the stock market, the equities market, the stock market, real estate investment, single family, multifamily, buying businesses, mergers and acquisitions, kind of a ton of different ways that you can invest. This book does not cover cryptocurrency. It does not cover NFTs. It does not cover a lot of the newer things that are not proven quite yet, but it gives you a good 30,000 foot view of why or how do they all compare to each other, long-term, short-term returns, risks, etc. It's called, it's by Paul Moore. It's called The Perfect Investment. That's a really great book to really kind of give you a head start on like, okay, out of these 15 things, what direction should I start really learning on, right? So that's really what I wanted to put in your hands, is something to empower you. And really quick, again, this is just something, if you'd like this presentation, you can have it, but this shows you our entire portfolio very transparently, all of the assets that we purchased, all of the prices that we projected we were going to sell at, returns. And again, so these are the sold deals are obviously past ones. And then any of these that are in progress, obviously, if you want to know what's going on, we actually have a quarterly investor meeting where those that invest with us can actually come together and we talk about our portfolio update so that everybody knows what is currently happening every quarter, every 3 months. So just again, a little bit about us, that we're not full of it, that we actually have done this. And if you'd like to get involved with our next opportunity, you can text 214-699-8810. Get qualified now, because that's the first step. We want to know what kind of investment you qualify for. Or if you had this presentation, you'd click that link. So that's pretty much how I'm going to end there. And once you get qualified, then we have a process to figure out how to do, or sorry, once you get qualified, then we can have a conversation about which investments would work for you in the future. So anyway, I noticed a couple options or questions come up in Q&A, and I'd like to stop sharing my screen and go to answer that, if that's okay. Okay. Chat City. I would like a recording of this presentation. Okay, cool. So we've got someone that wants a recording. Awesome. And then
yeah, so both questions are actually about the recording.
Okay.
It's going to be posted to YouTube. It's going to be posted to our blog. You can find it on our website. You can email myself. We'll send it to you. Any other questions, go ahead and type those in the Q&A or in the chat section, and I'll go ahead and read those off. Kaylee, thank you so much. That was by far the best presentation of all that I've seen you do. It was very informative. You gave us a lot of background on yourself and how you got started in the space and why you've evolved into crowdfunding. So I can't wait to interview you after this and get some one-on-one time with you. But next question, same thing. How can I get access to the presentation?
You're like, so talk so much.
Everybody's enjoying it, honestly. And we're live on Facebook as well, so I'm sure there's questions there. It's going to be on NuView's website, but if you wanted the link, I can email it to you after we do our editing. So it'll probably be available maybe Monday, I'm thinking. Any other actual specific questions on the presentation or for Kaylee or self-directed IRAs, go ahead and type those in the chat, everyone.
Let me see if I can get this link for you. Yeah, I just kind of want to hammer the point when it comes to self-directing your IRA, that what also will happen regardless of if it's a syndication, if it's JV is a little different, but really if it's a group pooling of money, and we, especially in a crowd fund where you have like 5,000 investment, 25,000, which is typical, there's a lot more people to kind of rally up and get together. And so in that situation, when you're using when you are going to plan to use your IRA to invest, it's really important that you self-direct that now, because any lag in time is going to cause you to miss out on that opportunity that is available. And then, I'm like, what is this, July? Do we have any holidays coming up with discounts or anything for opening up accounts?
Hey, I can always run a promo. You just reach out to me. Actually, we just sent an email out yesterday on the promo we're running for July. We are waiving your application fee, which is $50, and we're offering a $50 credit towards your first transaction. So that's going to save you $100 right there getting started if you aren't already self-directing. So I know I have a few questions, so I'm going to go ahead and get started. Let me ask you, with transitioning from syndications to the crowdfunding, what was the process like? How long did it take to make that change? Because I know starting a crowdfunding, just a fund in general, it's a process.
Yeah, so we still do syndicate, but what we did was essentially figured out a way that I could stop leaving people out, because that was another problem that I didn't really mention. But for like my grandma, for example, and actually our fund, Verna Fund, is named after her. She just passed away in May, so I'm really excited that I get to see her face or see her name every day. And move her legacy forward, because she was the one person that really advocated for me. But we still do syndicate in the sense of we do have an active live 506c offering, but that's for accredited people only. So
Right.
what about the rest of the people in the United States, which is 88% of the remaining population? They just don't get access to these investments. That's ridiculous. So that's what spurred my interest in doing, or basically getting vetted to do one of these crowdfunding offerings. And the process took 7-8 months total, because again, this was something I hadn't done before. And so, I hired an attorney that I won't get into that, but essentially wasn't my trusted, like, great, ethical, amazing attorney, Dugan Kelly, that I love, that just, I'm like, okay, fine, I will just do everything with you guys, because even when it comes to personal stuff, like, hey, Kaylee, you're behaving this way, and you could be a little more soft or whatever, just like things that matter with like being a person. But anyway, it took about 7 months to put the whole thing together. And then after putting together, because we had to figure out a way, okay, how do we crowdfunding? The way that it works is you cannot invest in an investment company. You have to invest in the physical asset itself. So the CF money, or when you put your money into a bank account that's owned by Crowdfunding LLC, it has to go directly into the asset. So we're like, well, how are we going to do this? How are we going to bring in accredited investors, let them invest into the same deals at the same return rate, at the same split, at the same whatever, but be able to get in at a lower rate? Because what I see with sponsors is they do the opposite. They're like, well, actually, if you give us like $1 million, then I'll give you like 9%, preferred return versus the 6.5 or whatnot. And I talked to a lot of investors, which is 88% of people, and they were like, that makes me feel not important. That makes me feel like I don't matter. That makes me feel not good, so how do we kind of go backwards or do it the other way? So it took a long time to set up, but so we still do technically have a 506C offering, which is what people put under the syndication category. It's just a document you file. And then we also have a 506, have a Reg C. So Reg D and Reg C at the same time. But without getting too complicated, essentially all the funds have to go into the asset in a particular order for everybody's funds to go in to get the same returns, the same split. That's like, just be as equitable as possible, depending on what you qualify to be able to invest. Because like I said, if you go into the crowdfunding platform and you have limits to what you can invest, and that's okay, but you just have to come into the entity a certain way.
Yeah. Okay. That makes sense. No, completely.
Very creative.
So it's not 506B, but it still allows for, non-accredited investors, which a lot of people listening are, fall in that category. And
88% of people, all of us,
Yeah. And I agree. They miss out on these opportunities, unfortunately. But their goal is to become an accredited investor. And that's why they're looking at these assets, and you're setting them up for success. That's amazing. I love what you're doing.
Yeah. I just thought, like, how would I want to be treated?
Yeah.
Like when I got started in my early 20s, I had less than $5,000, and I scrambled and got it together and took my IRA out of a company I was working for. I think I was able to figure out an in-service rollover or something like that. But anyway, put it into a note, because that was the only thing I could invest into passively at such a low amount, but it still pays me 8% a month for the last, I don't know, like,
I love when that happens.
I think we're safe. I think it's okay. So I don't know what I was saying.
Oh, you have a note right now, and it's still paying you your 8%. And
yeah, it still is. And actually
massive.
That account has doubled, and I'm out of my 20s now, but point is that doubling of whatever I put in there would have happened even if I put more money in there, if I had that at the time. So that compound interest curve got rolling early on in my life. And so I'm not going to be 50 going, okay, now I can invest. Shoot. I have, if you're lucky, 50 more years to live, but
Yeah. No, and I love you're appealing to a younger audience too. We're getting a lot more millennials that are starting to be more investment savvy, and they don't have those huge accounts, and they don't have those huge savings accounts, even their personal cash yet. They've been working maybe in the career field for maybe 10, 15 years at the most, but they weren't the best savers. But now that they're starting to learn and opening their eyes to these types of alternative assets, we're getting a lot more calls and a lot more applications coming in with people that want to just start from scratch, and they want to start saving, and they want to make these types of investments. So you're appealing to a huge range of audience that have really known about these types of investing or didn't have the ability to do it. So I love that. Let's see, I got a few questions here. What's an approximate cost or range and time frame to set up the SEC approval for a crowdfunded structure? So you kind of touched on that. It was about 7 months.
Yeah, it took, it shouldn't take that long, honestly, but it really was so it took so long because we were coming up with a creative structure to make it fit into crowdfunding, because crowdfunding was not developed for real estate. It really wasn't. It was meant for tech companies, or, hey, you got $200, you want to put it into an Indiegogo, etc. But because of the approval amount for the total raise being increased, it makes sense for real estate. But again, we just have to direct invest it from that entity into the asset itself. So that took a lot of time, more than it should have, to tell you the truth. And I'd be happy to honestly give you a referral to an attorney that's not going to stretch it out as long as possible to keep siphoning your money, because that's what they do. I'm sorry, that's what they do.
All right, everyone. If you have any other questions, I got Kaylee here for a few more minutes. I don't want to take up too much of her time. Now she's busy.
No.
Go and check those in.
We're good. I guess random people want to give me flowers. So I hope that's what it is. But anyway, so it took that long because of being creative. But again, net is that I've got someone that I should have initiated this with in the first place. They did a crowdfund for a winery in Texas. They did a crowdfund for a tech company. They did a crowdfund, and the guy does all of our 1031 transactions every year, during COVID, over $2 billion a year in just tenant and common transactions. Plus they do all the syndications and SEC work for it, being a securities attorney, basically. And again, just an ethical, good group of people. And, I've only experienced one of those out of 9 different attorneys plus that I've dealt with. So anyway, so to tell you the cost, it depends on what you need. So this particular offering was for real estate, so it took a lot of creativity, so it took more time. Whereas if you were doing a tech investment, or for this attorney, if you were doing a winery, or if you're doing my type of thing, they already kind of have a template for it, so likely it'll take less time. Honestly, if I look at the quality of work and I look at what was produced when it came to the investment itself, what I should have paid for that offering is probably $3,000 worth of work. But again, that comes with experience in knowing when to tell the attorney, okay, turn the ticker off. This is what you're going to deliver by Friday. This is what I will pay for that. And that is how this works. So you have to have boundaries with your attorney. And again, just like I said, Duke and Kelly will treat you right. But anyway, you have to have boundaries.
Yeah, no, I know Dugan. I have him on my LinkedIn. He's a great attorney. So they're asking, is there a minimum of 5K? So yes, if you're investing through the crowdfund, 5K, but if you're investing directly into the syndication, it's 100K minimum, correct?
So in this situation, if you're an accredited investor, your minimum is 50,000. And we go through our Invest Next portal. I'm happy to stick the accredited link into the chat. And then the second link will be, right now we're just testing the waters on the other one. So it should be live next week, but that is for everyone else that's not accredited. And so that one, depending on what preferred return you want, there's a cap table for all of this that you can decide what share class you want. But the minimum, if you're not accredited, is indeed segments of $5,000. Yes.
Okay, perfect. And they're asking who the preferred attorney contact was for setting up the crowdfund. So,
oh my God, Duke and Kelly Clark PLLC, or Asher, that works with him, or any of their attorneys. There's just a certain way that they do business that I think I like. They're very transparent, and I'm sending them all this stuff. Look what this person's doing to me. They're like, okay, stop. And they've saved me several times. Stop this. I'll send it to me. I won't even charge you to get up to speed. And not saying that they do that for everybody, but I hire them with all of our syndications when it does come to the 506 B and C so far. And so they're like, look, they just do the right thing. They're not always going to bill you for every breath you take.
Right.
So yeah.
Yeah, that's awesome. Okay, so I think that's all for questions. I didn't get any more. So we're gonna wrap it up. Remember, everyone, if you want to reach NuView, you can reach us through our website, NuViewTrust.com. We are running a promo for July. The promo is July 22, and you will get $50 off your application fee, as well as a $50 credit towards your first investment. So that will save you some change. We do not charge transaction fees anymore. We have one lump fee for the year that includes all your transactions. You can do as many transactions as you like. It's only $125. If you take advantage of this promo, your first year, you're only paying $75 for unlimited transactions. So that's pretty cool. And then after that, it's only $325 per investment. That's for any accounts that are over $15,000. If it's under $15,000, it's only $75 per asset. So it's very affordable for anyone that's listening, that's just getting started. It's definitely something you want to do, especially if you want to get out of the volatile stock market. This is a great opportunity for you. Kaylee did share some great links there for you guys. Go ahead and take a look at those. If you want to reach out to myself personally, my email is bmartinez@nuviewtrust.com. I'm always happy to set up a one-on-one consultation with you, and then we can figure out, what your plan is and how to get the funds over, and I'll explain the process with you. All right. Thanks again, everyone, for joining us, and we will see you next Wednesday, 1 p.m. for our Wednesday workshop.